Hello, I'm Sam Stovall, Managing Director, U.S. Equity Strategy. In this week's Sector Watch, found on www.getmarketscope.com, I told investors not to forget how high-yielding issues reacted to last year's threat of rising rates. A little more than a year ago, the former Fed Chair Bernanke first dropped the taper time bomb in his testimony before Congress. In the subsequent month, the S&P 500 slumped nearly 6%. Since late June 2013, the S&P 500 has regained its bullish bias and is now more than 15% higher than the pre-taper peak. Yet things are certainly not back to normal. The yield on the 10-year note is more than 80 basis points above where it was at its pre-taper talk level, despite undergoing a counter-trend rally so far this year. What's more, higher-yielding stocks are still lagging well behind their lower-yielding brethren. Even more telling is that nearly 1/4 of all companies yielding 2.5% or more remain underwater, having recorded a decline in price and dividends in the past year. In addition, the forward-year PE ratio for the higher-yielding category is currently trading at a 20% premium to the S&P 500 index. Therefore, when screening for high-yielding investment candidates, we recommend that investors don't yield to temptation by stretching for income by turning a blind eye to valuations and volatility. If the yield looks too good to be true, it probably is, and will likely increase your portfolio's overall beta when bond yields start moving higher once again. In other words, don't chase yield for yield's sake, but incorporate other fundamental valuation parameters into your search. I'm Sam Stovall, and I'll talk with you again next week.